So let's talk about ETFs. ETFs are exchange traded funds. And in layman's term, it's like trading options through a mutual fund. But then there's this thing what they call NAV erosion, net asset value, that dilutes. So think of it like this. Let's say you own a rental car company. You're renting the cars. Well, they're generating cash flow. But the cars, as you know, are steadily depreciating, right? Cars don't increase in value. But you created so much cash flow, at some period, you're going to sell those cars and you're going to sell them at a loss. Did you really lose money?
Not really, because the cash flow from the rental car exceeds all that depreciation.
Well, that's the same thing that we're talking about ETFs. They create such a high yield that is generating this cash flow. And so at the end of the period, the asset may have reduced in value, but you created so much money and cash flow, who cares? And if you blend that just like a juicer, man, you got some healthy benefits there.
So the idea is to blend those high yield ETFs that produce a lot of cash flow, but they're depreciating over time. You blend that with real estate, value add real estate, which in the beginning doesn't produce a lot of cash flow, but it appreciates over time. By blending the two together, now we can create the best of both worlds, right? We take advantage of both the massive cash flow from the high yield ETFs and the massive appreciation from value add real estate.